So we're looking at M1 and M2, and what I'd like to point out to students is the following. We have about $18.5 trillion of M2 money out there. And all this kind of stuff I can make transactions with. I can convert these things into purchasing power pretty darn fast. Notice how much we have in circulation. We have a little less than $2 trillion. About $16.5 trillion of M2 currency. So by far, most of our money, if you look at it, is not in the paper money, it's not in the coins, it's in bank accounts. All the other money is in bank accounts, checking accounts, savings accounts, time deposits, money market accounts. So that means that most of our money is not created by the federal government, it's not created by the Federal Reserve, it's not created by the U.S. Treasury. Most of our money is created by the private sector with banks, credit unions, money market firms. They're the ones that create our money. So now we're going to look at money creation through the banking system because that's where most of our money does come from. So we have to learn a few terms if we're going to understand money creation through the banking system. And the first term to understand is what are bank reserves. Reserves represent money deposited but not loaned out. So money deposited at a bank but not loaned out. We're going to find out that most of the money deposited at banks is not there right now. Most of it has been loaned out. That's why if we all go down to our bank at one time to get our money out, it's not there. That's what happens when you have a bank run. Your book talks about bank runs. And bank runs were generated because of, historically, before the 1930s, there was no Federal Deposit Insurance Corporation. Without that, financial system would be much more unstable. Probably of any of the laws that we've ever enacted at the federal level, this might be the most important one for the financial stability of the country. Bank runs were pretty common historically until we had FDIC. To be honest, if we did not have FDIC, the moment the coronavirus hit, I would have been down to my bank pulling out all my money. But now because my accounts are insured up to $250,000, I don't worry about it. And that has made our banking system much more stable. Now we have what's known as fractional reserve banking, and like I mentioned, most of the money deposited is not there right now, so banks hold a fraction of total deposits as reserves. Why do they do that? Well, that's how they make money. They make loans and they charge interest. If they do not make loans and do not charge interest, then they would have to charge us very high fees for us to hold our money with them for banking operations, much higher than they charge now. By the way, if your bank does charge you fees, I highly recommend going to a credit union. A credit union, they will not charge you fees usually on accounts. I've never heard of one that does. So my checking accounts have no monthly fees at them, and there's no minimum deposits for I should take that back. I do have a high yielding, not so much these days, of a savings account that if it goes below a certain amount, they will charge me a fee, which I found the hard way. I took money out and it went down below the threshold, and they charged me a fee. You have to read the fine print. So again, the rest of the money deposited has been loaned out, and only a fraction of total deposits are kept as bank reserves. Now, some of these reserves are mandatory. That comes from the Federal Reserve. The Federal Reserve has the power to force banks to hold what's known as required reserves. So know that for the quizzes, required reserves. I use capital RR for required reserves. This is the amount of reserves a bank cannot legally loan out. And the way the Federal Reserve determines this is by setting what's known as a required reserve ratio. That definitely is going to be on the quizzes. I use little RR for that. This is the percent of total deposits that must be held as required reserves. Why do we use total deposits? That's what the law says. That's what the Federal Reserve law says. The Federal Reserve has to, by law, mandate at least some required reserves to be held, and they have some discretion over what else they can do. They have some discretion over this ratio for certain types of accounts. And my questions on quizzes is going to be pretty simple. We're going to assume that the ratio, whatever it is, applies to the total demand deposits, total deposits. And the only deposits I'm going to have is going to be demand deposits to make it easy. So here's a question. If total deposits are $200,000 and the ratio is 5%, required reserve ratio, then what's the required reserves? Well, you take 5% of $200,000 and that'd be $10,000. So of the $200,000 that have been deposited, $10,000 have to be set aside as required reserves. This is simply a way for the Federal Reserve to have some kind of control over the amount of money the banks loan out. So this little ratio here, know that for the quizzes. You would answer a lot of questions with that. Now, if there are required reserves, then there got to be other kind of reserves, and that's excess reserves. These are the amount of reserves that a bank can legally loan out. Economists tend to use XR for excess reserves. And so your total reserves, TR, are equal to required reserves, RR, and excess reserves, XR. And these reserves can be kept in just two places. Currency and coin in the vault. Obviously, that's money that has not been loaned out. And the other place they keep it is deposits with the Federal Reserve System. We have different Federal Reserve banks across the country, and they have their own branches. The closest branch we have to us down here in Southern California is a branch in downtown LA. And so your bank, my bank, has an account with the Federal Reserve Bank in the 12th District, which has its bank in San Francisco, and their branch is LA, which is what my bank and your bank probably works with. So you can think of total reserves as going in two directions. It's vault cash plus deposits at Fed. And then you can also divide it up between excess reserves and required reserves. It's the same dollar amount. Banks probably keep most of the reserves on deposit with the Fed. That's probably easier, much easier to conduct transactions electronically than to use the physical stuff. And the physical stuff has transactions cost. You have to transport it. You have to put it into ATM machines. You have to have it transported through security systems between merchants and various banks and the Federal Reserve. So much easier, again, to simply conduct transactions electronically and use your reserves that come from the deposits with the Fed. We'll talk more about that later. So here's a question for the test, questions for the exams, quizzes. So we have our assets and liabilities with the Bank of Rancho. Over here, we have different kind of assets. We have vault cash, we have car loans, we have business loans, loans to small businesses, loans for people buying homes, mortgages, and we have deposit with the Fed. And our liabilities, we're going to have just demand deposits. I'm not going to have any net worth. That doesn't do any good for our analysis. So only the liabilities over here will be demand deposits. And we'll assume that the ratio, required reserve ratio, applies to all $1 million there. So the first question is determine the total reserves. So we'll look at the asset side. What money has been deposited but not loaned out? Well, that's been loaned out. That's been loaned out. That's been loaned out. Remember that reserves kept in two places, vault cash and deposit with the Fed. Probably should have said Fed deposits. So you take your vault cash and add your deposit with the Fed. And so that'd be $50,000 there, and then we have $300,000 there. Together, our reserves are $350,000. You can see that's this fraction reserve bank. They have a most deposited, but only 35% is left there. So they have 35% of the money deposited as reserve. And that's a good example of fractional reserve banking. Most money deposited, the other 65%, has been loaned out. Determine the bank's required reserves. Well, we use the ratio. We use little RRR times our demand deposits. And so the ratio is 10%. And then be 10% of the $1 million that's been deposited. And so that would be 100,000. The question is determine the excess reserves, and you have to ask the question: does the bank have enough reserves to meet the requirement of $100,000? And the answer is yes. So they have $350,000 of reserves. 100,000 is required. So this would be our total reserves. This would be required reserves. The remaining $250,000 is excess. And so that is what this bank can legally loan out as of today, $250,000. Banks will never loan out all excess reserves because they have to worry about people coming in to demand their money, right? We have $1 million in demand deposit with this bank. And if they loan out all reserves, they only have $100,000 of required reserves. Well, they can't touch that. And so if someone comes in to withdraw the money, it's not there. And so banks have to balance the need for daily withdrawals with their excess reserves. Excess reserves, if they're in the vault, they don't pay any. They don't collect any interest. We'll find out with the Federal Reserve that if they have their reserves deposited with the Fed, they pay a little bit of interest, and so that's probably where they want to keep it. But if they can make more money out in car loans and the other kind of loans, I'll pause here. Be back in a minute. Oh, what was I talking about? Oh yeah, banks will not loan out all their excess reserves because again, they have to worry about daily withdrawals. And then around this time of the year, or the holiday seasons, they have probably more money on hand for excess reserves to deal with the extra withdrawals as people will be spending more money for holidays. Probably not as much as, say, in a different year. With COVID, probably less people traveling and so forth. We still can buy things online, have it shipped to friends and family. Stop there.